Hello friends. Today the Honorable RBI Governor announced the Monetary Policy Committee decision to hold the repo rates constant, which means interest rates have been left unchanged. Allow me to say, I told you so. Why did I say that? I was saying this from the point of view of a check writer. You and me are check writers. We deploy money in the market, and therefore it is the decision between the interaction between the borrower, which is the bank, and the depositor, which is the check writer, which kind of brings equilibrium to the money markets. Now, what is likely as a fallout from the decision to hold these repo rates constant? What will impact and how it will impact your investments, your trading, especially your short-term trading, both in the options and in the futures segment. I promised you I would release a video, and here I am. Now friends, what we'll do in this video is first recap what the Honorable RBI Governor said, and then we'll break it down in simple language that simple-minded fellows like me can understand. Remember what I told you in my earlier videos. The financial research industry excels in complicating things with a fantastic jargon, just like Mr. Amitabh Bachchan did in Amar Akbar Anthony in that song, My Name is Anthony Gonzalez. He said, by the hemoglobin of the atmospheric pressure in the country. Well, no such thing exists, but it makes you sound intelligent, right? So we are going to dumb this down, and we are going to make this very well understood by the retail Joe like me. Well, the RBI very clearly wants the flexible inflation targeting framework which it has put in place to make sure that the runaway inflation in essential prices is curtailed, so that people can actually begin to save money or enhance their savings, which is how they'll be able to have surpluses to invest and to trade. Now, Austrian School of Economics differs slightly from your conventional economic theory. Austrian School of Economics practitioners say that inflation index is also called the misery index. Because higher prices eat into the savings of an average household, it makes the household members miserable and their savings rate goes down. To the extent that if the inflation index is extremely high, there have been instances in the past where an average citizen has had to resort to personal loans from institutional lenders, maybe even non-institutional lenders, which is your friendly neighborhood money lender or sahukar, just to meet their PCE. PCE stands for personal consumption expenditure. So your toothpaste, your toothbrushes, your shoe polishes, these are basically a personal consumption expenditure. So after meeting all these expenses, you should still be able to save some money, which is how stock markets go up when savings rise. Now, the first announcement that the Honorable RBI Governor made was that he kept the repo rates change, which is the interest rates were kept constant. Now, I told you this because of a simple reason, that whatever you've learned in school and college about interest rates and lower interest rates helping the GDP and all that, I have absolutely no dispute with that. But unfortunately, a financial education system ignores the other side of the coin. It only talks about the borrower. In this video, my previous video on interest rates, I have told you that there is a second aspect to interest rates, and that is of a saver. The borrower would love to have lower interest rates, but does the saver who actually deposits the money in the bank like lower rates? No, they don't. And if they stop writing checks, it causes a liquidity problem. So the RBI governor understood this, and this is something that I said in my earlier video. I also posted on my social media accounts and wrote a money control column that I want interest rates either to stay constant or push my luck even further and say, please, Mr. Governor, raise the interest rates. The RBI governor also announced raising the projected inflation from the earlier 4.5% to 4.8%. Ouch, that's going to hurt a bit, but unavoidable. I've been telling you since October 2021 onwards that inflation is going to rise, and here it is. And there's also another announcement which again is worrisome, is that the projected GDP growth rate, which was earlier announced at 7.2%, has been eased to 6.6%. So there is a reduction in the outlook for the GDP growth itself. So it's actually a double whammy. You're going to have inflation going up, which means your household saving might just come down a tad, and then your cost of funds is likely to stay elevated. This is not exactly good news for borrowers, and I can understand if I receive some negative comments from people who have to pay EMIs and interest rates. My heart goes out to you. Now, I wanted to hear what he would say about interbank call money or overnight rates, since by the time the next monetary policy committee meeting is around the corner in February, but we'll be on the eve of the end of the fiscal year 2024-25. In India, remember, we have 31st March as the financial year end. Now, since that meeting of February will be very close to the financial year end, I wanted to know what the interbank call money rates would be like. And thankfully, to my great relief, the RBI governor announced that the interbank call money rates would be linked to the repo rates and they would not be allowed to run away. Now, just as you and me as business owners, we reverse entries, what we call entries. Entry utarna hai, entry saltana hai. Okay, that means reversing the entries. Whatever loans that you've taken during the year, you want to pay back so that your balance sheet looks healthier. Whatever short-term outgoings that are still outstanding, your current liabilities, you would like to pay them and show that your net worth is robust. So what do? You might have to resort to short-term financing. Now, banks do that to basically attain the optimal SLR, CRR, PSA, which is priority sector advances, etc. So they borrow money from each other, and this market can give and take money based on the hour, by the hour. There have been times during the past, whenever there have been cash crunches, the interbank call money rate has shot through the roof. And that's when private financiers also step in. They lend money because, hey, it's bank guaranteed, right? So, unfortunately, these zooming rates can create problems in the banking system. And the Honorable RBI Governor addressed this issue, which I'm very, very thankful for. Now, the major announcement that the RBI Governor made. Now, this was with regards to the cash reserve ratio or CRR. Now, cash reserve ratio on the NDTL, net demand time liabilities. Now, what is net demand time liability? Net is a word you understand. Demand is a word you understand. You call for something, you demand. Time, on what time? And liability, on what time, at how much money would be your liability? Let me explain. Now, supposing I put in a fixed deposit in a bank. Now, this is a very, very simplified version, so don't hold me up for it. Supposing I was to put a deposit in a bank of, say, 1 lakh rupees for 1 year. And you, my dear viewer, were to place a deposit in a bank worth 2 lakh rupees for a span of 2 years. What happens to the bank where its NDTL or net demand time liability is concerned is, after a year, the bank's NDTL is 1 lakh rupees, and after 2 years, it will be 2 more lakh rupees. Now, it needs liquidity so that when I, after a year, want my money back rather than extending the deposit, it should be able to pay me back on time. And that is how trust is built in a bank. To have an ample amount of buffer, the banks are told to create CRR deposits with the RBI. Now, this CRR on the net demand time liability, NDTL, was 4.5% before today's meeting. The RBI governor has reduced the CRR from 4.5% to 4%, and this will be put into effect in a staggered manner. 25 basis points, which is quarter of a percent, will be reduced on 14th of December 2024, and then quarter of a percent more on 28th of December 2024. Now, this move is expected to release liquidity of 1,16,000 crores into the banking system. Now, before you say, hey, the CRR going down would mean that A, the bank's cost of money remains elevated because it's not reducing the interest rate. B, even the buffer that it's keeping is cut down by 0.5%. I understand you. I hear you. But do remember that up to 31st March 2022, the CRR was 4%. It is only after the money taps were tightened, the interest rates were raised, and CRR was raised from 4 to 4.5%, that the inflation was targeted in this manner. So we are basically going back to the level of what we were up to 31st March 2022. So believe me, CRR at 4%, we've been there. What does it impact you? How does it impact you? If you're a fixed deposit holder, chances are soon enough the interest rate on your deposit is likely to come down. Why? Because in a staggered manner, like I said, 14 December and then 28 December, 0.25% each, the CRR is going to come down. So chances are that your banker, now this depends on bank to bank, okay? Chances are your banker might tell you, hey, Mr. XYZ, you have a deposit here. We are going to cut down the interest rate on your deposit by XYZ%. And you have an overdraft or a loan account here. We are going to keep that rate constant because the CRR has, the repo rate has not been changed. Can that happen? Yes, it can happen. The interest rate on your deposit can fall, which I think it will, but the interest rate on your outstanding loans will not fall. That's tough for a borrower. Like I said, the very thumbnail of my video says, this RBI Monetary Policy Committee meeting has favored the check writer, not the borrower. I have more for you. Now, the biggest announcement from my perspective, of course, you can feel free to defer. My comment segment is open to your feedback, is the announcement on the FCNRB deposit. Now, FCNR is foreign exchange deposits put in by NRIs typically. Now, if you have been following me long enough, if you have been part of my online family long enough, you will remember how I used to warn you right through May and June of 2022, wherein I used to tell you, hey, I expect some moves on increase in interest rates on FCNRB deposits by NRIs. And sure enough, the Honorable Finance Minister, Mrs. Nirmala Sitharaman, appeared on television on 6th of July 2022, and I wrote out a WhatsApp update immediately to you saying that effective on 1st July, which means with retrospective effect. Remember, she appeared on television on 6th July 22. She said with effect from 1st July 2022 right up to 30th October 2022, the rates on FCNR deposits by NRIs would be freed. They are no more capped, but they would be subject to negotiation between the bank and the depositor. What do you think happened? Do you think the NRIs came out there and said, hey, I want a lower rate of interest now that interest rates are flexible? No. They demanded and they got higher rates. Similarly, the Honorable RBI Governor today announced that he is hiking the interest rates on FCNRB deposits. Now, this tells me that the RBI is very clearly clamoring for more and more dollars. Do remember that our foreign exchange reserves have fallen by approximately $60 billion, if I'm not mistaken. So the demand for more dollars is understood. In those days, the Honorable Finance Minister had said that all additional deposits garnered between 1st of July 2022 to 30th October 2022 would not be included in computing the NDTL. Will the present increase in deposit rates on FCNR also result in the same? I have frankly no clarity because the Honorable RBI Governor did not clarify it. Probably the following presser or the press conference, which is customary, will have more details for us. But allow me to explain to you as to what he announced. What the Honorable RBI Governor has announced is increase the FCNRB deposit rates to alternative reference rates, which is the interbank rate, plus 400 basis points, which is 4%, which earlier up to today was ARR, alternative reference rate, plus 250 basis points or 2.5% for all deposits up to 3 years in tenure. So what he's very clearly saying is, I am willing to pay 1.5% higher interest rates on FCNR deposits up to 3 years. Now, what about deposits over 3 years in tenure? What he has done is raise the interest rates on FCNRB deposits between 3 to 5 years from alternative reference rates, which is ARR plus 300 basis points, to ARR plus 500 basis points. Now, what he's very clearly done is raise the interest rate by 2%. That's a big move. That's a very big move. If this is not helping the check writer, I don't know what is. Very clearly, I have been telling you that rates need to go up. Forget about the non-market participants, forget about the non-check writers, forget about the decibel level noise that they generate in the market. It is the check writers' money that moves the needles and gauges in the markets. And the RBI governor has very, very clearly said, hey, I don't really want to get into your bad books. Continue to writing checks. We need the money. All right. So it's a check writers market out and out. And if at all you are a borrower due to any circumstances from any segment of the institutional market, I'm sorry, but you're unlikely to have any relief anytime soon. So the cost of funds are likely to stay elevated, which I have been saying for many quarters now. As a matter of fact, from October 2021, I've told you that the era of easy and cheap low-cost money is over and cost of funds will go up. And I told you, you should start laddering bond yields. Here you go as a screenshot of what I put up on my social media accounts. It's not a coincidence that the RBI allowed participation to the retail investor in the government securities and gilt markets by launching the RBI Retail Direct GSEC portal on 1st October 2021. If you've been with me long enough, I had made a video. In those days, I was a consulting editor to an advisory firm. I had made a video saying you should participate in the RBI Retail Direct GSEC portal. So the impact on IRS or interest rate sensitive stocks remains unchanged. So I will continue with my strategy of theta decay in the non-linear options segment, in especially the skewed options, which I explained to you in earlier video, that where the premium in strike price is equidistant from the spot rate. If the strike of 50 rupees higher for the call and the strike for 50 rupees lower for the put, the premium is disproportionate. These are called skewed options. I would say that theta decay in these skewed options as a strategy would continue as far as I am concerned. It depends on your comfort level as to what you would like to do. Now, what happens to options and futures traders? It frankly depends on which side of the fence you are sitting on. Are you a buyer or are you a seller? Remember, this is a check writer's market. So you will in all likelihood pay higher premium if you are an option buyer. Why? Do remember your option Greeks. What are the factors that determine the options premium? Time to expiry, difference between the spot and the strike, and RFR, risk-free rate, which is the interest rate. Now, the cost of money, I have been telling you, please, for God's sake, familiarize yourself with the concept of cost of money, or you might as well kiss your money goodbye. In the coming quarters, you're going to have a whole lot of Jane Streets of the world from the West coming and setting up shop in India. If you cannot compete with them on the cost of money concept, goodbye. All right. So these guys, when the cost of funds is going up, will charge you a higher premium on the options that you are buying, which means the options buyer is at a disadvantage. The option seller, the check writer, is at an advantage here. Do remember that the Securities and Exchange Board of India has tweaked the rules a little bit. Now, earlier you could do calendar spreads, which mean buy the front month future and short sell the the next month future, because the next month future, all other factors remaining constant, would have a positive contango or cost of carry. So as and when expiry came closer, there would be convergence of the futures price between up to the closer to the spot, and you would then basically roll the calendar spread forward. Why do people do calendar spreads? Because it's a delta neutral strategy. You're long in one, short in the other. So the exchange used to give you a discounted span margin on the leg where the margin was lower. Remember that SEBI has said no more discounted margins for calendar spread traders on expiry day, which means you have to put in full amounts of money. And hey, cost of funds just went up. It is a check writer's market. The guy who's deploying the money, the guy who's saving money, the guy who's lending money. So option buyers and futures buyers who are rolling their position forward and paying a cost of carry are going to see smaller take home profit, because cost of money is going to go up. Do remember, one of the four factors of production is capital, and the cost of capital is just going up. The legendary late Sir John Templeton said, as I said in my earlier video, that he would like to invest his money of Templeton funds into those economies which rewarded the saver rather than rewarding the borrower. How do you reward a saver? By raising rates. How do you reward the borrower? By lowering interest rates. By raising the cost of funds, even though it is on FCNRB deposits, and at least not cutting interest rates, which would have been detrimental to you and me as check writers. The RBI governor has actually done us a good favor. On behalf of check writers, I express my heartfelt gratitude and a big warm thank you to the Honorable RBI Governor, Mr. Shaktikanta Das. Thank you, Mr. Das, for keeping the cost of funds constant for Indian investors and raising it for NRIs. Before I sign out from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments segment, do let me know how my videos help you become better traders and what I can record to help you become an even better trader in my future videos. Also, a reminder to share my videos with smart traders like yourself so I can reach out to a wider audience to help spread the cult of knowledge-based investments and trades. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Take care. Bye-bye.